Good morning, everyone. The markets are falling fast under the meme stock without Reddit's love. The S&P 500 just dropped 11% in 2 days. Everyone's screaming, buy the dip. But what if the dip turns into a dive? Today on the Sensa Edge, we are not chasing candles. We are building a glide path, the condors, butterfly, and what kind of strategy we can bet on. Okay. Good morning, everyone. This is your host, Zoheb. The mood of the market as of the last few days has been, shall we say, a bit pessimistic, more pessimistic than an Auburn fan on Sunday, more pessimistic than a turkey on a Thanksgiving morning, more pessimistic than ice cycle in a firestorm. It's been rough. The S&P 500 dropped 11% in 2 days. That's not the worst it's ever been, but it's not all that far off. So where do we go from here? All the retail trading community is clamoring to buy the dip, which is arguably the best indicator in the world to stay way far away from the US equities at the moment, or get heinously short. If you're an option trader with a bit of experience under your belt, getting the short delta isn't all that difficult. Doing it intelligently is another story. The implied volume is still extremely high, currently sitting at 46, down from 60 this morning. So simply buying the short delta via the long puts is off the table. So what do we do? What can be the strategy? Let me bring up my screen and then very quickly jump into this. One of the things in the sensor market is you can track all the big institution players here. So what are their portfolio currently looks like and what they will be actually betting on in the few weeks to come. They have to file their 13-year filing, which is coming up in about a month or so, and any big stock change, which is 5% and above, we're going to bring this up, and then we can continue to track how the players and the institutional has been doing. Like you can tap on Warren Buffett's here. This is how the portfolio has been like spread across. You can go into different portfolios, Bridgewater Associates, Mr. Dalio's thing. You can like continue to search, see how the portfolios has been spread and how they continue to change or rebalance their portfolio in the few weeks to come and few months to come. Also, a good way to do a track is options flow. Every single day, thousands of different option flow orders come in, and then you can like filter here. What are the different calls, bearish, puts, and things coming across? You can even filter who are the big premiums, which is coming, calls, it could be puts, and then you can see the different strike prices, the expiration, the premiums, how the bullish calls or bearish puts and everything. So you can continue to track on those particular option flow orders as well. All right, let's jump back in and then let's talk about few of a different strategy here and what could be a good one. We can probably like pick a strategy like the beauty of different flies or a condors. If you want a bearish delta without the volatility exposure, you're going to look at the condors or the butterfly. Buying or selling vertical spread cuts down the volatility exposure anyway, since you're selling and buying option in the same expiry at the same time. A condor could be a good strategy here. Again, it's buying a vertical or selling a vertical at a finance pace at the same time. So in effect, it's multiplied, very little volatility exposure with both of these AM options. The importance of expiries and strikes here. Choosing an expiry and a set of strike for a fly is a bit of an art form. You want enough time, but ideally not too much time. Playing flies and condors requires different time target. Think we are going full nuclear in 90% down move? Fine, but you still have to know where you think it's going to happen so that you can plan accordingly. And again, I've looked up all the 50 retracement in the S&P since inception, and they were all done by 2.5 years from the top. But buying something 2 years out in SPX subjects you to number of issues like liquidity and fearful prices. The SPX is one of the most liquid product in the market, but trading a 3-year butterfly is no easy task. You'll need to do some price discovery, start with one lot to find the true price, and then add quantities once you found a fair price and work accordingly quite a bit. Again, with the VIX at 46, a shift from backwardation to contango can do some damage to any option strategy. Balancing the neutral volume exposure with the bearish bias is difficult to say the least without resorting to short-term fluctuation and gamma. It's a messy situation, and IMO, a longer dated condor or a fly, is the way to go. I'm going to bring up the screen and then we can jump right into that particular strategy. Again, you can also sell very cheap premium against it to recoup any theta lead and grab some additional income while you're waiting. but just realize that will go away as the volume drops, or you'll be forced to get closer to the money to get into it. Again, today's trade to capitalize on the above is relatively simple. And as I bring my screen here, you can see the strategy, which is nothing but iron condor put strategy. As you can see here, in this case, long put condor, again, expiring somewhere 2 to 3 years down. I picked up December 27th, again, just to give you an how exactly the strategy could work. I'm taking a position of 2,500, buying 2,500 put, selling 2,900 put, and selling one more 3,100 put, and buying 3,500 put out here. So what I am betting here is it's going to go down somewhere, and the break-even here in this case is anywhere between 2,500 to 3,500, somewhere around. The debit to enter this particular position currently stands somewhere around $12, so $1,220. But if this particular strategy work, and the profit could be somewhere around 38,000. Again, that's the strategy. The full, the risk, there is always a risk. This is not a cheap trade. Make sure again you're comfortable losing the entire premium here, which is $1,220. But again, very unlikely that you lose easily 50% of the premium paid. Could be a loss. But I think if you're betting against this bearish and the SPX to go down this, somewhere 2 years down, again, you can change this particular expiration. You can change and adjust as things need for this particular strategy. All right, that's it for today's episode on the Sensa Edge. The market are in free fall, and this trade can act like a parachute or a straight up bet to the downside. Again, thanks for tuning in. Be sure to subscribe and leave a review and follow us on the platform. Until then, trade safely and allocate responsibly.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.